and a very good evening, ladies and gentlemen. I'm Rashmi Mohanty, Head Group Investor Relations Vedanta. Thanks for joining us today to discuss our first quarter results for FY 2019. We will be referring to the presentation that is available on our website. From our management team, we have with us our Group CEO, Mr. Kuldeep Kaura, our Group CFO, Mr. Arun Kumar. We also have several of our business leaders with us on this call. Sudhir Mathur from Oil and Gas, Sunil Duggal from Hindustan Zinc, Deshni Naidu from Zinc International, Sameer Khaire and Ajay Dikshit from Aluminium and Power, Naveen Singhal from Iron Ore and Steel, and P. Ramnath from Copper India. Let me now hand it over to Mr. Kaura to provide an update on the company's operational performance. Mr. Kaura.
Thank you, Rashmi. Good evening, ladies and gentlemen. I am pleased to welcome you to Vedanta Limited's Q1 earning conference call. Operationally, this has been a good quarter. We are ramping up production across our business segments, and in Q1, we made good progress. Volume ramp up from our underground mining operations at Zinc India and at our aluminium business continued at a good pace. We see further visibility on our oil production targets. We also completed the acquisition of electro steel during the quarter. However, we did have a few setbacks as we started FY19 with the shutdown of our iron ore operations at Goa and copper smelting operations at Qtr1. At Goa, given our commitment to the region and the considerable impact on the local economy, because of the shutdown, we continue to engage with the government for resumption of mining operations. Regarding the Qtr1 operations, we have filed an appeal before the National Green Tribunal Principal Bench challenging the rejection of renewal of CTO and closure of the existing plant. Our copper smelter is among the best copper smelter in the world in terms of operational performance and environment practices, and the plant uses the best-in-class technologies. We'll continue to engage with the relevant stakeholders on this matter. We also delivered a strong set of financials. I am happy to report that Q1 EBITDA was rupees 6,529 crores, 31% higher year on year with a stable margin of 34%. Net debt/EBITDA remained strong at 1.1 post payout of dividends and the electro steel acquisition. We remain excited about our portfolio of businesses as the fundamentals for metal, oil and gas and other natural resources in India continue to be strong. Our commodity prices, despite some pullback in metal prices recently, especially zinc and copper, on account of global trade war concerns and the appreciating dollar, we feel that prices will stabilize in the medium to long term. Slide on safety and sustainability. Vedanta remains focused on zero harm, zero waste and zero discharge, but regrettably 3 fatalities at our businesses overshadowed our health and safety efforts in Q1. Let me assure you that all of us in our executive team are committed to our safety goals and to bring Vedanta to the best HSE performance in the resources sector. We are focusing on enhanced visible leadership on the ground, risk management and use of digital technologies to make the workplace safer and have taken some notable initiatives on training in this quarter. Digital projects on accent control and geotagging have been launched on a pilot basis and shall be replicated across the organization. Our focus in our environment practices continue to save energy and water, and we remain committed to our FY19 targets. We also institutionalized surveillance program of our tailing dams at all Indian sites, readying them ahead of monsoons. Finally, on the community front, we started operating the recently established cancer hospital in Nava Raipur, which offers comprehensive, modern and high-quality medical care. Moving on to our businesses operational update. Zinc India. MIC during the quarter was 212,000, lower by 17% from our last quarter. From this quarter, SZL transition to fully underground mining. This was completed in a safe manner and underground output ramped up by 7% quarter on quarter from 197,000 tons in quarter 4 to 212,000 tons in quarter 1. Metal production was generally in line with availability of mined metal. The ramp-up of Rampur-Agucha mine will be accelerated with the recent commissioning of additional ventilation systems and mid-shaft loading platform. Our cost of production ex-royalty was higher quarter on quarter due to low volume, maintenance shutdown costs, and impact of waste settlement. We remain on track to achieve our 1.2 million ton MIC target in FY20. FY19 is an important year for us as the gap in our production on account of closure of open cost operations will be filled with ramp up at our underground mines. Our underground mine production will increase progressively every quarter, and we are confident of reaching our guidance of surpassing last year's record production and will target a 1.2 million ton MIC run rate as we exit this year. Major milestones on shafts are on schedule, and mill commissioning at SK and Zawar are expected in second half of the year. I am pleased to inform that we have received environment clearance from MOEF for expansion of ore production at SK mine from 4.5 million ton to 6 million ton per annum, enabling us to accelerate the production. Phase 1 of our strategic vision to grow our zinc-lead output from 1.2 million ton to 1.35 million ton is in the planning and evaluation stage. Zinc International. Moving to Zinc International, production was low at 25,000 tons, mainly on account of a planned maintenance shutdown at Skopje during the quarter, which was partially offset by improved recoveries at BMM. The lower production volume and Skopje maintenance shutdown expenses also increased the COP for the quarter, but we remain on track for our full year cost guidance. As Skopje Pit 112 ore mining and metal production is expected to ramp up from quarter 2 with higher production expected in second half of the year. Going forward, all production at Skopje will be from Pit 112. At Hemsberg, almost 100% of pre-stripping work has been completed. About 0.5 million ton of ore stockpile has been built. The crusher has also been commissioned and crushed ore stockpile is currently being readied. Mill commissioning activities have started and we are expecting the first commercial concentrate production in September after a minor delay due to fatality at the site. We continue to work towards full year production of 100,000 tons. I'll now hand over to our oil and gas CEO, Sudhir Mathur, to speak about quarter 1 performance. Sudhir.
Thank you, Mr. Kaura, and good evening to you all. Let me start off with the performance for the quarter. We are progressing well to deliver the FY19 target of 200 to 250,000 barrels per day. With more wells being brought online, our average gross production across assets was 195,000 barrels per day, 3% higher quarter on quarter. The execution of various growth projects involving capital expenditure of over 2.3 billion has commenced. We have 7 drilling rigs on site, which we shall ramp up to 14 rigs by Q3. MBA infill, UR polymer, and ASP projects are on track. 2 wells have been brought online. This will increase to around 16 wells by Q2. The year shall see a substantial jump in our gas production driven by 2 factors. One, the GIGL pipeline is expected to be brought online in Q2, which shall enable us to increase gas production by 50%. Second, the work on the gas terminal has commenced. In the interim, we shall be deploying early gas production facilities to double the gas production by Q4. We are progressively increasing the liquid handling capacity at the Mangla processing terminal to produce incremental volume. At Aishwarya Barmer Hills, the first of our tight oil projects, the first oil is expected in Q3. We are also investing in exploration.
Sudhir Mathur, you're not audible.
Hello?
Yes.
Is some problem in the call?
No, sir. Sir, Mr. Sudhir Mathur is not audible. I'm just trying to...
It's the mailbox of...
hello, sir.
Mr. Sudhir Mathur?
काही स्टेशनरी पाहिजे आम्हाला रबरचं पॉकेट
Ladies and gentlemen, you are requested to stay connected while we reconnect the speakers. We have the management line reconnected.
Mr. Kaura, you'd like to...
Sudhir was there, so he's at ABH.
Yes. Well, let me start with ABH. At Aishwarya Barmer Hill, our first tight oil project, the first oil expected in Q3. We are also investing in exploration. Rajasthan exploration campaign consists of 7 to 18 wells, is well on track for spud in the second quarter.
Sir, I have muted that line. You may please go ahead.
Thank you. Sorry about that. The Rajasthan tight oil appraisal drilling for 4 tight oil fields is planned for the second half of FY19. Beyond Rajasthan, in KG offshore, the first well of the 2-well exploration campaign has spud in April 18. We are looking to make significant additions to our current acreage under the government's open acreage licensing policy. We have bid for all the 55 blocks on offer. The award is expected in the second quarter. Thank you. And back to you, Mr. Kaura.
Yeah, so thank you, Sudhir. Coming to aluminium. Aluminium division continued the strong production trajectory from last quarter and delivered record volumes of 482,000 tons and an improved margin of $425 per ton in Q1. The key focus in this segment is on cost and improving realization. During our FY18 results in May, we have guided to $120 to $170 per ton savings in our aluminium COP year on year by optimizing controllable costs and elimination of one-offs while excluding impact of market factors. Let me provide you an update on this. In Q1, we have achieved about $50 per ton of the saving, driven mainly by improvement of power plant operating parameters, elimination of port revival one-offs, and reallocation of cell relining expenses. We have started receiving high-quality Odisha bauxite through OMC for our Lanjigarh refinery, and this will meet a third of our bauxite requirement this fiscal. Alumina production of 325,000 tons this quarter was lower quarter-on-quarter due to temporary issues in the bauxite handling unit. However, we are on track to ramp up production to 1.5-1.6 million tons this year with increase in Odisha bauxite. On coal, the focus is on increasing linkages through Tranche 4 auction and improving the materialization of current linkages. We are also improving the power plant operating parameters and GCV loss elimination. With these key cost drivers, we retain the savings target for the year. On the marketing side, we continue to focus on improving net premiums by progressively increasing value-added production from 43% of total sales in this quarter to a 59% exit rate in quarter 4. Electro Steel. During the quarter, we completed the acquisition of Electro Steel under the IBC process. We see this acquisition at an attractive pricing to be a strategic fit to create an integrated iron and steel business. We will consolidate the financials of ESL for a 10-month period in this fiscal. The ESL plant is located in Bokaro, which is in the vicinity of major raw material sources, including our proposed Jharkhand iron ore mines, which are only about 250 kilometers away from the asset. The plant currently has a hot metal capacity of 1.5 million ton and a design capacity to go up to 2.5 million ton with additional capex. It produces long steel products, wire rods, rebars, DI pipes, billets, etc. In the last financial year, the asset produced around 1 million ton of output at an EBITDA margin of $55 per ton. It has been a little over a month since the completion of the transaction, and we are in the process of integrating it within our group. Our plan in the near term is to stabilize production from the asset and to strengthen its various functions such as commercial and marketing, while simultaneously working on ramping up production to its full current capacity of 1.5 million ton per annum. Once this is complete, we will be able to substantially improve EBITDA from current levels. This will get us ready for the next phase, which is the expansion to 2.5 million ton. In parallel, we continue to work on our plans on Jharkhand mines, which will help create further value with the synergies that are possible. In summary, Vedanta is on a transformational journey with significant growth across its businesses. The key enablers for driving this growth are the use of technology and innovation to drive best-in-class and low-cost operations, skill development, and global experience leadership to steer the project delivery with sustainability at the forefront. To summarize, Zinc India is on track to gradually ramp up and is targeting a 1.2 billion ton MIC run rate at the end of this year. Habsburg will ramp up in an accelerated manner once commercial production starts in September. Aluminium ramp-up is on track and we are targeting $120 to $170 saving on FY 2018 average, excluding market factors as per previous guidance. Oil and gas development projects are in the execution phase and production ramp-up will continue progressively. Electro Steel acquisition has been completed and integration is underway. We have maintained our guidance for FY19 across our business segments. With key growth milestones coming up in the upcoming quarters, we expect the performance to progressively improve as we advance through the last 9 months of this financial year. Over to Arun to provide the finance update.
Yeah, thanks, Mr. Kora. Good evening, everyone. As outlined by the CEO, the quarter saw the company deliver on growth projects with Zinc India, Ansberg at Zinc International, oil projects as well as oil output making good progress. Some key highlights of the quarter. EBITDA growth of 31%, robust margin in the 35 to 40% range, which we've always indicated in the past. Guidance on volumes, cost remains unchanged. See the appendix. No change in the full year tax rate, interest income percentage, depreciation trend guidance as indicated in the May results call. Third highlight would be the healthy ROC at about 16%, up over last year by 110 basis points, reflecting improved asset earnings. With that, the other balance sheet indicators on net debt to EBITDA continues to be robust at around 1.1x. The attributable PAT and EPS is up marginally. It's a play of mark-to-mark on investments and translations as we go below the EBITDA. Finally, on the income statement in the appendix, only 2 points worth mentioning is a one-time charge of certain commitment charges in the finance cost line, interest income impacted by the mark-to-marks given the adverse movement in the yield curve. No change, however, in the full year tax rate, the investment return income percentage as indicated in the May results call. The next page on the EBITDA bridge, it's largely self-explanatory, but I'll focus on the operational side. Volumes, aluminum and oil volume growth showed up. Rest of the businesses offset each other with the adverse impact of the non-operational Copper India coming up as well. Zinc India, though lower, was largely in line with the mine plan in the absence of open pit at Rampura Agucha. On the cost side, primarily on account of the volume-led absorption of the zinc businesses and changing coal mix in aluminum with more imports in auction coal. The others bar is mainly impacted by the power import in aluminum and the catch-up on account of Zinc India, the long-term settlement signed with the direct and the indirect labor. But it's not abnormal but higher than the accounting estimate. Both these expenses should cease in quarter 2, so largely can be considered as a one-time in quarter 1. On the final page on the debt maturity profile, the company has been very proactively managing its maturities of long-term debt with all of FY19 largely refinanced. The company continues to enjoy good access to various sources of liquidity, be it bank or bond market. Raised around 10,000 crores of debt this quarter, largely for refinancing the year maturities while also part funding the electricity acquisition. Not much of an update otherwise this quarter on the credit ratings. They continue to be solid. The gross debt was constant to March levels while the net debt was up, primarily driven by the acquisition of Electro Steel, as well as converting some of the working capital trade finance products to loan funding, as we also highlighted at the end of fourth quarter. We continue to have around 35,000 crores of cash on hand. With this, thank you all and back to Mr. Kora for the rest of the business section.
Operator, we can now take in the questions.
Sure, ma'am. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anshuman Atri from Premji Invest. Please go ahead.
Yes, thank you for the opportunity. So my question is regarding the aluminum segment. There are reports of getting bauxite from Guinea through arrangement and as well as from the local Orissa bauxite. So can we expect a sharper ramp-up of alumina production for backward integration going forward? And on coal, you're seeing more and more coal which you're getting domestically, which is leading to lower power cost. So how do we see the overall coal integration for Vedanta as an entity? and on this bauxite?
Yeah. So as we said that we have started receiving bauxite from the Orissa mines, and we are ramping up these mines and the logistics arrangements. And this ramp up will result in supply of about 1/3 of our bauxite requirements this year from this mine. And this figure, obviously, going forward, will keep on improving as we continue to ramp up the mine at the high rates. And as regards the second action, which is also happening at the Nandigarh refinery, is that we are ramping up our production to its the capacity throughput rating, which will enable us to produce 1.6 million tons this year. But this number will also improve to 2 million tons in the near future after that. And so both these factors will reduce our dependence on imports of alumina as well as bauxite, and thereby impact our costs substantially. And as regards coal, we continue to work with the coal mines, to improve the GCV losses, where we have some success already, and also to improve our materialization as per our linkages. And in the case of Jharsuguda, we also try to get additional linkages for our captive units. So both these factors, along with the better performance of our power plants in terms of specific consumptions and also PLF, reduce or eliminate power imports altogether, all these factors actually will lead to a significant reduction at the number which I was quoting, about $120 to $170 range.
So was there any arrangement for bauxite supply from Guinea?
We are importing bauxite from EGA, and that's in a standard long-term contract.
Okay. Thank you, sir.
Yeah.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Anuj Singla from Bank of America Merrill Lynch. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, following up on the bauxite thing, now what kind of cost savings can we expect from this, maybe on an alumina or aluminum front, given that obviously the transportation cost as well as the quality of this bauxite is going to be much better, I guess. So what kind of cost saving can we expect?
I mean, we can slice and dice this number of $120, $170 per ton this year. So, I mean, the numbers are really combination of bauxite input plus a ramp-up of our aluminium refinery, plus, of course, savings because of the power plant operations. But overall, I mean, there will be obviously substantial savings because of the logistics cost reduction and the other input costs. Yeah.
And so the pricing for this contract, so these are long-term or they are index-based? What is the kind of pricing mechanism here?
Samir, would you like to respond to this?
Yeah. So, Orissa bauxite OMC is, as you know, the government policy driven by auctions. And of course, the bauxite which we get from Guinea, etc., based on indexes which move. But the bauxite which we get from OMC is based on an auction which is driven by the government.
Okay. Okay, and the second question is on the net debt. During the quarter, we saw around 6,100 crores of working capital adjustment because of which the net debt has gone up. Does that relate to the copper business? Can you just clarify on that?
Yeah, as I mentioned earlier, you see at the net debt numbers reported, our net debt to EBITDA continues to be healthy, 1.1. which offers a tremendous strength to the balance sheet and a good headroom from any point of view. The quarterly movement is fundamentally a combination of the electrosteel acquisition and the working capital representing what I mentioned. Some of the working capital products, more specifically the buyer's credit, converted into term loans, given the RBI actions during the quarter 4 for the industry at large. So that's broadly, from a reconciliation point of view, the most fundamental thing, of course, being, as I mentioned, the ratio of net debt to EBITDA. I hope that answers your question.
Yes, sir. The second follow-up on this is actually, should we expect this to reverse in the ensuing quarters, or this is like a steady state kind of thing which we should expect? So the term loans are going to stay high and this is not going to go back into a buyer's credit again?
So actually, the company as such, we have rolled out a significant initiative. While some of this will definitely reverse, but more importantly, the company has embarked on a significant initiative of re-looking at working capital from ground zero. In fact, we have some global partners working with us to do global benchmarking in this, and we have benchmarked ourselves to the best in the world. And if we have to be sort of what we term as a ruthless player in terms of being the most efficient to manage our working capital, we believe that there is tremendous potential of anywhere between $1 to $1.5 billion in terms of leaning the balance sheet. So the company will make progress during the year and drive some excellence into this whole vertical of working capital management. Having said that, a short answer to your question would be, yes, a lot of it should see itself reverse during the subsequent quarters.
Thank you. The next question is from the line of Sumangal Nevatia from Macquarie. Please go ahead.
Yeah, good evening, everyone. Thanks for the chance. First question is on the zinc international business. The Amsberg mine, the restart or the commissioning has been delayed by almost 3 months, but we've maintained the full year volume at 100 KT. Now, assuming 6 months of operation, that gives you around 80% utilization on a 250 KT capacity. Can you elaborate how the sharp ramp-up would be achieved?
Yeah, so earlier the guidance for Amsberg commissioning was middle of this year, around middle of this year. And that unfortunately got slightly pushed back because, as I was saying, certain events and the accident there. And now, I mean, from a mining point of view, the mine is fully operational and we have a stockpile already built in, more than a month's stock. And so it's really the concentrated commissioning and ramp up. Our definitely attempt is to make the ramp up faster and plan it better. And this time which we have got has also helped us in that direction. So what we are saying really is that as a management team, we are committed to do a faster ramp up and target 100,000 ton or close to 100,000 ton.
Understood. Okay. Second question is with respect to the aluminium COP. This quarter...
Hello?
Hello? Hello? Yeah, am I audible?
Operator?
Hello, ma'am. Can you hear us? Hello? Sumangal, just hold on. Participants, you are requested to stay connected while we reconnect the management. the line for the management reconnected. Sumangal, you may want to repeat your question, please.
Yeah, thanks. My second question was with respect to the aluminium cost of production. Now, this is, I think, the first time where cost of production at VAL is almost equal to BALCO. So just wanted to understand if higher cost of imported alumina is the main factor here. And the second part of the question is the guidance for full year at 1750 versus first quarter at almost $1935. So assuming that commodity price deflation doesn't happen only from the cost saving with respect to bauxite and coal linkage, what sort of cost of production we could end FY19 at?
I mean, as we were saying earlier in the discussion, that assuming no impact because of the commodity prices of alumina and also the coal prices in the auctions, if you keep those as market dependent, our cost saving targets is about $120 to $170 per ton, in that range. And as of now, we are making good progress and we're quite confident that we'll hit this number.
Okay, and with respect to the cost at BALCO and VAL being same, can you share what is the key reason? Is it because of higher cost of imported alumina being loaded at VAL COP?
I think, we can get into those kind of details, but as an overall aluminium, we have given you the numbers. I think that should broadly work for you.
No problem. I'll get in touch later. Thanks. Thanks and all the best.
Thank you.
Thank you. Next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is for Deshni. Any specific update on the South African mining charter wherein we might need to reduce our stake in BMN and Gamsberg?
Ritesh, can you hear me?
Yeah, I can hear you.
Yes. Thank you for the question. I think the version of the mining charter we are dealing with is a much better, I think a much industry-friendlier version than the amendment that was proposed a couple of months ago. So I think we see that as an encouraging development. If you look at the way the charter is worded now, once empowered, always empowered means that we don't have to go and re-empower a stake should Exxaro exit from the asset. So that's also very encouraging. The move is to make sure that we've got more broad-based empowerment. So if we are to look at any future transactions, it will be around communities and employees as opposed to getting a BE partner as a replacement to the current Exxaro structure. So I think we are, as a business, I'm encouraged that the charter with government is moving in the right direction. I don't see increased risk. In fact, I see slightly minimized risk the last time we had this conversation.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for taking my question, sir. Can you please throw some more light on electro steel? I mean, what kind of exit capacity utilization we can look in FY19 and FY20?
As we were saying earlier, this is just about a month. This unit is with us and we are integrating it. And the first stage is 1.5 million tons. And then, of course, some improvements in overall product and marketing strategy. That's really the first stage. And then, of course, as a second stage, it goes to 2.5 million tons with some balancing equipment and additional capex. So, I think maybe when we come back to you in the next quarter, we would have had a time to, understand the operation in much more depth, and we'll be able to give you then the right kind of guidance.
Okay, sir. The second question is with respect to power cost at Jharsuguda. it has inched up quite sharply. So, I mean, what kind of power cost do you see going ahead in this year?
In power cost, basically, I think our power plant operations improvement should take place. And so what we have, certain power outages and our really fairly, substantial cost comes from in case we have to import power. Otherwise, our operations are improving. And going forward, really, our aim is to get our power cost around $550 per ton. That's the kind of number we are really looking to achieve as we approach towards the end of this year.
Okay, fair enough. Sir, I have a couple of more questions, but I will get back in the queue. Thank you.
Yeah.
Thank you. The next question is from the line of Saumil Mehta from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. Sir, while we agree that we have a pretty strong balance sheet, but, given the NCLT assets, what we have, Electro Steel and also news reports on Chhattisgarh, the GMR assets, how should we look at the balance sheet from a net debt to EBITDA perspective? I mean, is there a benchmark wherein at some point in time we will not breach that number irrespective of how the lucrative assets are?
I think it's a good question. Now, broadly, if you see our philosophy, and we used to talk a bit about it last year on capital allocation, fundamentally run our assets, ensure that ROC inches up so that you produce a good quality set of cash flows. And that's been our broad effort, if you see in the last couple of years, where we have ramped up across all our businesses, and pretty much every dollar of capital employed today, barring the few projects being executed, is producing return, which is why the ROC is also moved up to almost a 15 to 20% range from what used to be below 5% a few years ago. So that kind of gives us the flexibility to not only keep strengthening the balance sheet. Please remember that the net debt to EBITDA would also mean, the EBITDA is a variable factor. So as it keeps improving, the balance sheet strength obviously keeps improving further. After providing enough for self-funding our growth capex, ensuring enough returns for the shareholders, and reducing the gross debt where possible, the net debt rightly isn't much of an issue. Any opportunistic acquisition like what we have done in the recent past, coming in at good IRRs and good return for the investors, would be pursued definitely in the field around which we already operate as a diversified natural resources player. So it should be looked at in that broader canvas and context. And the net debt to EBITDA level has enough headroom here, but definitely one should broadly categorize it as a AA plus category, corporate and higher, is what we'd always aim to be in.
So, if I were to look at the overall balance sheet deleveraging, which had stopped a few quarters back because of some of the acquisition, when should we see that, again, starting, do we have any, benchmark or timelines in place wherein maybe 2 or 3 quarters down the line, we can see some sort of, free cash flows?
I used to struggle to answer the question a year ago when it was asked, your net debt to EBITDA is already so low, right? What else will you deleverage further? And which is when we mentioned that we'll, after taking care of these three, any opportunistic cash will always be deployed. So it's the same answer. There's nothing much to delever further at a 1.1 net debt to EBITDA level. So one should wisely invest into growth capex and returns to shareholder, which is absolutely where our focus is at this point of time.
Sure. And so my last question with respect to, the $150 cost reduction, what we are talking about in the aluminum business, can we, broadly assume that the three buckets like alumina, coal costs and the other costs will have equal savings, or you see one of the bucket getting higher share of that cost savings?
So basically it's alumina and the power plant and coal, which is the two main buckets, and as we said, better operations, which will avoid this port revival of costs, one-off costs of that nature. So if we take everything together, fundamentally it will be the power side which is actually the major part of the savings.
Perfect. Thank you so much, and all the best.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Vineet Malu from Birla Sun Life. Please go ahead. Vineet,
hello.
Yes, please.
Hi, good evening. I have one question is about aluminum segment. Can I know what was the cost of bought out alumina during this quarter? And do we expect this to come down based on current prices of alumina?
Yeah, I think broadly, the cost of bought out alumina keeps fluctuating with the index as mentioned, and really the management focus is on ensuring that the $150, which is controllable cost as we define it, where in the first quarter it's close to about $35 to $50 that's been achieved. And in the second quarter, we find that inching to maybe touch 100 or slightly beyond, and that's where I'll probably pass it on to Samir if he has any broader comments to make while the alumina prices will keep going up and down. Samir?
Yeah. So I think Qtr1 alumina imported was around $490 per ton landed. You can calculate what it would be FOB, but of course we cannot give any guidance going into future because these are highly volatile prices, as all of you are aware. And we focus on what is controllable, logistic cost, our own alumina production, and of course buying imported alumina as efficiently as we can, rather than forecasting the price of that alumina. But currently for the Q1, that was the range about $490 per ton.
Sure. So what was the number in Q4? How has it moved QOQ?
Q4 was around 500.
Okay, so it's on a downward trajectory.
Downward, but as I said, I don't think we are forecasting or giving.
I understand. Yeah, I understand. Appreciate that. My next question is on the free cash flow part. In terms of net debt to EBITDA, you said that you're fairly comfortable with, and you don't see much further deleveraging. So it's a marked shift in your strategy where virtually we should presume that all of the cash generation would be invested in growth projects. Is that a fair understanding?
No, actually, let me again clarify the understanding. If you look at the last 3 years of the trends of free cash flow, if you may put it, last year, broadly as a group, we generated about $1.7 billion, if you recollect the number. Of course, taking out some of the bias credit that we converted to working capital, the number was a bit lower, closer to 1.1. But otherwise, 1.7 on a base of $4.05 billion EBITDA. And the previous year was 1.5 on a base of 3.2. And the year before that was 1.7 on a base of 2.3. And for us, free cash flow would mean, and as we have guided in the past also, is post-growth CapEx. So we self-fund our CapEx. And what is left after that is for primarily meeting the objectives of either reduce your gross debt further or net debt if you so choose to, or returns to shareholders if the board decides as appropriate, or as opportunistic acquisitions, like classic example being Electro Steel, where you had the opportunity to integrate your Jharkhand mine with a ready-made steel asset, probably returning EBITDA to capital in the ratio of 1:5 as in a 5-year simple payback, meaning an IRR of plus 20%, thus creating better value for the shareholders. That's exactly how it will be. So there's no hard and fast answer to the question, save and except that the free cash flow is post-funding growth CapEx and will be well deployed towards these objectives, including acquisitions, if any, not with the objective to pursue acquisitions only.
Sure. No, I understand. I'm not, questioning whether 1.1 is good enough or not. Okay. I mean, I'm saying in the absence of any specific target of, returning X amount of cash to shareholders, and no further target of deleveraging, I must presume that it is growth projects which includes acquisitions, right? That's what I want to make sure.
Yeah, I think all the objectives will be balanced, and I would only like to take this opportunity to highlight the fact that we put in dividend policies in place which is both at Hindustan Zinc returning a minimum 30% of its net profit, and at Vedanta Limited a pass-through of Hindustan Zinc plus a 30% of the balance minimum, which is a very progressive dividend policy if you look at it globally actually, and also given a strong dividend return to the shareholders, approximately 7.2% if you look at FY18 average share price and the dividend paid. So I'll probably leave it at that. Balancing the objectives is critical as always.
So just lastly, in terms of returning cash to shareholders, are you also exploring options of buybacks like globally companies are engaging in? Or you would say dividend is adequate for now?
Yeah, I think those are matters best left to the board, but if there are tax-efficient ways of doing it, example, a buyback over a dividend, one will always scan the possibilities for that. Idea is always to maximize what return we can provide to the shareholders if we can without a leakage on dividend distribution tax.
Sure. Thank you very much.
Thank you. The next question is from the line of Palak Shah from Reliance Life Insurance. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. Just two questions. One is on delisting of Vedanta PLC.
You speak up a bit. Your voice is feeble.
Okay. Can you hear me now?
Yes. Fantastic.
Yeah. Just wanted to know regarding to the delisting of Vedanta PLC, are we looking to support our parent in the same?
See, the delisting is being driven by the parent of PLC, so there is no such link whatsoever. We understand from the news reports that and the RNS release that the independent committee, which is a board committee of PLC, has studied the offer and has also recommended the same to the shareholders of PLC. So that's exactly what we know and what we can share on this call. There's no such linkage to any parent.
Okay. And secondly, are we planning to enter any new mineral ore or metal? And if the parent Vedanta PLC looks to enter India, does he have the right to go on a standalone basis, or it has to go through Vedanta Limited?
I think, we have a fairly diversified portfolio of metals, and our main focus is India and brownfield growth in most of these areas. There will always be opportunities which we'll evaluate as we go forward. And maybe some of the other opportunities lie within our own businesses. For example, in terms of cobalt and areas like that, which we'll look at.
Okay. Just my question was a reference to in case if merchant mining in coal opens up in India, Vedanta PLC looks to acquire an asset on that basis, does it have the right to go on a standalone basis, or Vedanta PLC will acquire an asset through Vedanta Limited?
Yeah, if the merchant coal mining opens in India, we certainly will be interested in that, and we'll like to obviously supplement our coal requirements via that route. Plus, of course, if there's any commercial possibilities. But maybe Arun, you can put some light on the second part.
Yeah, I think Vedanta Limited has shaped up over the last couple of years. If you see the simplification process that has happened, SESA and Sterlite merger and Kane and Vedanta Limited merger, it's created a behemoth, which is part of the BSE 30 as well as the NSE 50. In terms of India play diversified and only natural resources sector company in India. So that's our primary vehicle of investment, capital creation, contribution to the exchequer, and that's the way to look at it primarily.
Okay. Got it. Thank you so much.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal. Please go ahead.
Hi, sir. This question is to Mr. Sudhir Mathur regarding oil and gas business. First thing is that is there any one-time adjustment in the revenue? And you think the cost of production is inching up. So the question is that where will it, head to over the next few quarters?
No, there is no adjustment to the gross revenue at all. As far as cost is concerned, it has gone up marginally from quarter on quarter, but we expect it to be below $7, which is a long-term guidance we have given. But it's really a function of the workover rates that are being used to bring more wells online in production.
Right. Just a related thing. If I correctly remember, you mentioned that exit rate of the production was 200,000 barrel per day in the fourth quarter, and we actually did less than that in the June quarter. So, where is the slippage?
So we had one shutdown in Rabha, which is a mandatory shutdown which we take for maintenance. We lost a bit of production there. And Rajasthan, we are ramping up production, as I mentioned. So, it's remained pretty stable. We've added 3% on an overall basis, coming also from the drilling program that we are doing from Cambay.
Okay, thank you.
Yeah, and, as we mentioned that, 16 wells will be online in Q2, which will would be drilled and completed in Q2 from the current 2 wells, so that should add to the production in Q2.
Okay, thank you.
Thank you. The next question is from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Good evening, sir. So, in case of the copper business, we had the EBITDA loss. So, are we doing anything to reduce fixed cost there, and any guidance on basically a fixed cost number or a loss number till the smelter restarts?
Yeah, I think, the copper business, the team is doing a very focused job at the ground level on seeing that the community contact and the other programs continue. So it's important to keep investing a certain amount of cost there. Having said that, the business is in the process of maximizing the EBITDA possible with the refinery in Silvassa, because that is another asset that we have that we should remember. And then through either the anode route or blister route, there is always a potential to make $75 to $100 per ton of EBITDA at that place, where the monthly capacity can go up to 20 to 21,000 tons per month. So that's the focus area for the management at this point of time. And to your point, it's a very good thought that you're left with us. Can we maximize Silvassa and cover the fixed costs? An excellent thought we'll carry back to the copper team.
And so other question is the working capital increase of 6,100 crores on your slide 21. So what this pertains to?
Yeah, I think we addressed that question a little earlier. So perhaps we can get back with the IR team for further replies. I'd like to give the opportunity to other questions, please.
Okay, thank you.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to Ms. Rashmi Mohanty for closing comments.
Thank you, operator, and thank you everyone for joining us today for the first quarter FY19 results call. As always, the Investor Relations team is available, and you can reach out to us for any further queries you may have of the results. Thank you, everyone.